The impact of ESG reporting on corporate market value and investor decision-making. For decades, investors asked one question: how much profit did you make? But today, the world's biggest fund managers controlling trillions of dollars are asking a second, more dangerous question: how did you make it? Welcome back to the channel. Today, we're decoding ESG reporting. It's no longer just a feel-good buzzword. It is a financial metric that is actively shifting corporate market values and redrawing the map of investor decision-making. If you're an accountant, a finance student, or an investor, you cannot afford to ignore this. Let's dive in, defining the ESG framework. First, let's define the pillars. Environmental looks at carbon footprints and waste management. Social examines labor relations and community impact. Governance audits board diversity and executive pay. But why does this matter to the bottom line? In the past, these were externalities. Today, they are material risks. A company with poor governance is a fraud risk. A company with poor environmental standards is a regulatory risk. ESG reporting is the tool that makes these invisible risks visible to the market. Impact on corporate market value. So, how does this affect market value? It happens through three main channels. Lower cost of capital. Data shows that companies with high ESG scores often enjoy lower interest rates. Why? Because lenders see them as lower risk bets. Operational efficiency. ESG isn't just about saving trees. It's about saving resources. Efficiency in energy and waste often leads to higher margins, which the stock market rewards with a higher P/E ratio. The premium effect. Modern investors are willing to pay a green premium. High ESG ratings act as a seal of quality, driving up demand for the stock and, consequently, its market cap. How investors make decisions now. Let's look at the investor's lens. Institutional giants like BlackRock and Vanguard now use ESG integration. They don't just look at net income. They look at ESG ratings from agencies like MSCI or Sustainalytics. Negative screening. Investors are flat out divesting from sign stocks or high polluters. Positive selection. They are actively seeking out best-in-class ESG performers. Risk mitigation. ESG reports help investors spot a Deepwater Horizon or a Volkswagen Dieselgate before it happens. If a company's ESG report shows weak internal controls, smart money leaves the room. The greenwashing challenge. A word of caution: greenwashing. As ESG becomes more valuable, some companies are painting their reports to look better than they are. This has led to a massive demand for independent assurance. This is where the accounting profession steps in. We are moving towards standardized global frameworks, like the ISSB International Sustainability Standards Board, to ensure that when a company says they are sustainable, the numbers actually back it up. Summary and call to action. The bottom line. ESG reporting is shifting from a voluntary PR exercise to a mandatory financial powerhouse. It drives market value by reducing risk and attracts investors by proving long-term viability. What do you think? Is ESG the future of finance, or is it just a temporary trend? Drop your thoughts in the comments below. If you found this breakdown helpful, hit that like button and subscribe for more contemporary finance insights.